Hi, my name is Arthur. So today I'm going to share with you a very special case study. So recently I met a guy, owner of a company, 35 years in this business. He has, in 2 countries, he has 2 sewing companies. So he manufactures this outwear for special workers, technicians outside. So it's like waterproof and etc. etc. So we had a chat and asked him, do you need a loan? And he said no, because we're brokers, we're helping companies to grow with the debt so we can increase your return on equity. He said, no, I don't need any loan, I'm okay, loan is not for me. Okay, so we had a chat, I take his business card, so the next day I check his financials, and you know what I see? I see very bad situation. So this guy, hear me out, he's working for 35 years, right? He has around 70 employees, he does around 1.2 million euros per year in revenue, and for the last couple of years, he's working practically like zero revenue, so he's zero profit. He has balance sheet around, so it's revenue, he has his profit, he has balance sheet around 400k, right? So it's 1, 2, 3, and he says to me, loan is not good for me, I'm good without. Okay, but when I check his finances, you know what I see? First of all, I see that he, from 400,000 on the balance sheet, he has almost zero equity. All equity was used up by the previous loss of the company, right? So it means the 400k of the assets is sitting somewhere in liabilities. What it means that 200 of those he owns to government in taxes. Next thing, he has some pledges on his accounts by some suppliers that have supplied him like sewing equipment, etc. He didn't pay them. So it's again 200k suppliers. So he owns, and he has already courts going on. So he has pledges on his assets, he has pledges on his equity. Those guys are suing him, and he's owing 200k, like 50% of his assets, to local tax authority. Imagine that. And this guy is saying, I don't need any loans. Imagine that. He's willing to take this risk with the government. We don't mess with the government. He's ready to take the risk of the supplier, and he's saying no to debt. Like, why? Because many entrepreneurs, they don't understand that if you have 400k assets, what you can do, you can take, I will share that in minutes, guys, you can take like 50 to 70% of the asset worth, right? Because liabilities is assets, and take it as a loan, inject it in working capital, increase revenue, increase profit, have more money in your account at the end of the day. But he didn't do that, and it sounds interesting. You know why he doesn't do that? Because he does not understand how debt works, how borrowed money can increase your return on equity and the leverage. So let's check this one. That was actually funny. And now, so there are few misconceptions about loans and how it works in real life. So first, all the banks, all financial institutions around the world, there are about like 10,000 of those, they do practically the same thing. First, they look at your revenue. So if you don't have any revenue, just forget to receive any kind of money from banks and alternative lenders. There are some revenue-based financing companies, invoice financing companies, they're just classical banks. They calculate your debt service coverage ratio, but if we talk like in simple terms, from 10, sometimes to 30% of your revenue is the amount of loan you can get. So let's say I have 1 million revenue per year. It means my loan, what I can take approximately about 100 to 300,000. Respective euro, dollars, you just get the numbers, right? So this is the math. This is what banks are looking for. The second thing that, because if you don't have any real revenue, it means you don't have any customers that are paying to you, right? And the banks want to have what? Want to have like stable revenue from stable customers, big ones, not like first-time customers. It depends, B2C, B2B. It's better to have stable revenue cash flow, predictable cash flow. Then, at least for 1 to 2 years, then you're bankable. So I'd say 2 years revenue. It depends on the country, on specifics of the business, but you need to have revenue. Without the revenue, just forget about the debt funding. So we can call it like, I don't know, debt funding 101. But without an incoming stream of cash flow, just forget about banks. The second is assets. So you need to have some kind of assets on your balance sheet. And you can pledge them and get a loan. Now, the biggest misconception is that bank will lend me money without any collaterals. Yes, it's possible. Bigger you are, stronger your balance sheet, bigger probability the bank will give you money without any collaterals. But in most cases, they want to have a pledge, because the owner of the equity is those guys who are having the risk first, right? And then the bank. So bank doesn't want to have a risk on the balance sheet. Therefore, they always take the first pledge, the first collateral on your assets. So what's the range? It depends on the valuation, right? So it's a loan to value. So if the asset value, let's say it's again like 1 million euros, then approximately, depending on valuation, where the asset is, how liquid it is, it can be somewhere about 30 to 70%. It depends country by country. So if you have 1 million, it means that the bank, based on assets, can give you a loan from 300 to 700,000. Now, which number bank will take? Most probably this would be the maximum based on the assets, how much you can cover. It depends again on the industry. And then he calculates how much money you can really pay back. So based on the revenue, they go through your EBITDA, earnings before interest, taxes, depreciation, amortization, and see how much really you can pay. So here comes the debt service coverage ratio. You guys need to check that out. It's very important when you go to the banks. You know your DSCR. You know your asset value. So here's the valuation. Check with the local guys what's the value for assets. I remember we had one customer. He's a farmer. He has a lot of equipment and it's not on the balance sheet. I don't know how it's possible. He has equipment. It's not being put on the balance sheet. Therefore it's slim. But when you go into the books, you can see that. It's crazy. So when a bank sees that, he combines it and then goes with some kind of offer to you. And that's it. Then these are the two most important factors. If we can do something about how to raise money for the banks, it's revenue and assets. Then of course they have other criteria. We have free books for that as well. They look for the equity. Because banks, even though you have revenue, if you have assets, if you have zero equity, bank most probably will not give any money because they will have really solid debt equity ratio, right? So debt equity depends. I'll say 1-on-1 is good, and then we can go up and forth depending on the risk on the country, etc. So let's say if this guy has 200k equity, right? So it means maybe 1-on-1, 1-to-2. So bank could lend from 200k to 400k, right? You follow me on this one? So this is the range the bank will be willing to give based on equity. This is the range bank will be willing to give against the assets, and this will be willing against the revenue. And then they put that together on fancy formula. They look at your taxes, your payment, and many other soft and hard factors, and then in total they calculate. Actually, another misconception is for you guys is that banks actually are calculating your possibility to pay back the loan. Because some owners that I talk, they think, bank doesn't understand me. False. Banks are really understanding you. They're calculating the probability of your default. They calculate how much cash you can pay out with the DSTR, with cash flow planning. They put it in a fancy formula and say, okay, we want you DSTR be 1.4. If the loan term is 5 years, interest rate is 6%, just for sake of numbers. Then based on the cash flow, and it's like full installment payment, no bullets, just a monthly regular payment. Then giving all this, we can give you, 345k loan. Because they calculate from your revenue based on the current numbers, this is how much you can pay out. Because this you need to divide by 5 years and get how much money you pay in installments, your principal, and then there goes the interest rate, right? So given all these numbers, this is how bank sees it. And you know what's most interesting? That the guy we talked about before, he has revenue, he has assets, he has zero equity. And he's thinking he's not going to the banks because he doesn't need money. In reality, when we talked to this guy, we said that you need equity. So it's not about that you don't need a loan to borrow, it's about that you need equity. You need equity in order to raise debt. And in order to have equity, you need to rethink your unit economics. This is something also I want to... Unit economics. You need to make sure that you make profit on every dollar or euro that you put on your working capital. Then your business model is profitable, you're making money. So that's it for today. These are most important topics about how banks are evaluating balance sheets of the company. Again, depends on the country. If you have some questions, drop me in the comments. We really like if you could subscribe to my channel. Now I'm just starting out. I think in my third or fourth video. I have 15 years experience in business lending, in consulting, in debt fundraising. This is my main expertise, so I know how to do that. My mission is to help you guys, all the entrepreneurs around the world, to grow their companies. The biggest misconception is that debt is bad. Debt actually is good and can increase return on equity. So let's say this could be an example. If I borrow 345K, in my net margin, let's say 20%, interest rate is 6%, so I make 14% net profit. I put that money injected in working capital. Let's say, for the sake of number, I can turn that money 3 times, so I can make 1 million extra revenue per year. With 1 million, I can make 14%, it's 140,000 euros extra money per year. So let's say with 20% here from 1 million, revenue is 1 million, I make how much? I make 200,000, right? 20%. Minus interest on this one 3 times, 140. So guess by how much we increased, so it's totally 300. So you guys see 340,000 euro per year you can make. And it's almost double. You almost double your revenue, your net profit. So by going to a bank, borrowing 345,000, increase your leverage and increase your return on equity. So first, you increase your profit by almost 2 times. Second, you increase your return on equity also like double. So this is the magic behind debt funding. So thank you for watching. Put a subscribe and write me in comment what you like, what kind of questions you have, and what kind of content you need for the future. Thanks a lot.